Employer-sponsored plans and marketplace plans are two common ways people get health insurance, but they are not chosen in the same way. One is connected to a job, while the other is bought through a public insurance marketplace. The source of the plan affects cost, timing, and options. Employer coverage is often subsidized through the workplace, while marketplace plans may use income-based subsidies. The employer often pays part of the premium, which can make the monthly cost lower for the employee. Employer-sponsored insurance is offered through a workplace. That employer contribution is a major reason workplace coverage can look attractive. The cheaper option is not always the plan with the lowest monthly premium. Marketplace plans are individual or family plans purchased through the health insurance marketplace. In everyday life, depending on income and household size, a person may qualify for subsidies that reduce premiums or out-of-pocket costs. Eligibility matters as much as the sticker price. Deductibles, family members, doctor networks, prescriptions, and employer contribution all change the real comparison. The first comparison is monthly premium. The real answer depends on the household's numbers. A workplace plan may be cheaper because the employer contributes, but a subsidized marketplace plan can sometimes compete. A worker with a large employer subsidy may find the workplace plan difficult to beat. An employer plan may have strong local hospital access, while a marketplace plan may use a narrower provider network. Doctors and facilities should be checked before switching. The second comparison is network. A self-employed person or someone between jobs may rely on marketplace options to keep coverage continuous. Family coverage can change the calculation. An employee-only workplace premium may be affordable, while adding a spouse and children may become expensive. That is why the cost of covering dependents needs separate attention. Employer plans often look cheaper because part of the premium is paid by the workplace. This rule can surprise families. Marketplace subsidies usually depend on access to affordable employer coverage. If the workplace plan meets affordability and minimum value rules, subsidies may be limited or unavailable. Subsidy rules can change the final cost quickly when income changes. Open enrollment timing is different. Employer plans follow the workplace benefits calendar, while marketplace plans have their own enrollment window unless a qualifying life event applies. Missing a deadline can leave fewer options. Marketplace plans can become competitive when subsidies reduce the monthly cost. Leaving a job may trigger COBRA, a marketplace special enrollment period, or coverage through a new employer. Job changes create special decisions. The gap between plans should be planned carefully. Comparing plans requires looking at both predictable premiums and possible costs during a bad health year. Deductibles can matter more than premiums during a medical year. The plan should be judged against likely use. A low premium plan with a high deductible may cost more if surgery, pregnancy, or chronic care is expected. The best choice is the plan that fits the household's doctors, medications, budget, and risk. Prescription coverage deserves its own check. A medication covered affordably under one plan may be expensive or require approval under another. Drug lists can change the practical value of a plan. A family should compare the total yearly cost, not just the amount taken from each paycheck. Premiums come out of the paycheck, and the HR department may help explain benefits. Convenience can reduce administrative stress. Employer plans may offer payroll deduction convenience. The right plan is the one that still works after income changes, prescriptions, and family needs are included. Marketplace plans offer portability outside a single employer. A freelancer, contractor, or person between jobs may value coverage that is not tied to one workplace. Independence can matter when income or employment changes. Changing jobs can make marketplace coverage important because it may prevent a gap in insurance. The tier should be read with the deductible and network. Bronze, silver, gold, and platinum labels generally reflect how costs are split, not the quality of doctors. The metal tiers on marketplace plans describe cost-sharing levels. Employer coverage may limit plan choices, while marketplace coverage may offer several metal tiers. A workplace plan may include extra benefits. Compare the whole benefits package. Dental, vision, wellness programs, health savings accounts, or disability coverage may be bundled with employment benefits. Income estimates matter because subsidy eligibility can change if earnings rise or fall. Subsidies can make coverage possible for people who would otherwise delay care. Marketplace plans may be better when employer coverage is unavailable or unaffordable. The marketplace is designed to create an option outside work. Employer plans often look cheaper because part of the premium is paid by the workplace. The hardest cases involve households with mixed needs. One spouse may have employer coverage, while children or another spouse may look at marketplace options. Families sometimes need to compare separate paths. A plan that covers the right doctors can be better than a cheaper plan that disrupts care. Both scenarios matter. Before choosing, estimate a normal year and a bad year. Normal care shows everyday affordability. A bad year reveals deductible, coinsurance, and maximum exposure. Marketplace plans can become competitive when subsidies reduce the monthly cost. Employer-sponsored plans often win on employer contribution and convenience. Marketplace plans can win on flexibility and subsidies. Neither path is automatically cheaper or better. The right choice depends on income, family size, doctors, prescriptions, and medical risk. The real comparison includes premiums, networks, medicines, deductibles, and the risk of a bad health year. Compare premiums, networks, deductibles, subsidies, medication rules, and enrollment deadlines side by side. The safest decision is made with actual plan documents, not assumptions. Health insurance is easier to choose when the numbers are visible before the year begins. A family should compare the total yearly cost, not just the amount taken from each paycheck. Changing jobs can make marketplace coverage important because it may prevent a gap in insurance. Employer coverage may limit plan choices, while marketplace coverage may offer several metal tiers. Income estimates matter because subsidy eligibility can change if earnings rise or fall. A plan that covers the right doctors can be better than a cheaper plan that disrupts care. The practical comparison is a full-year estimate, not a quick premium comparison. Employer support, marketplace subsidies, expected prescriptions, doctor access, and possible emergencies all change the answer. A plan that looks cheaper in January can become more expensive after one specialist visit if the network or deductible does not fit the household. The comparison also changes when family size changes. Adding a spouse or child can make the employer plan expensive, while a marketplace subsidy may or may not help depending on household income. A person should compare the full family cost, the doctors available, and the worst-case out-of-pocket number before deciding. The decision also depends on timing. Someone leaving a job, starting freelance work, or waiting for a new employer plan may use marketplace coverage as a bridge. Someone staying with an employer may value payroll deductions and predictable enrollment. The stronger option is the one that keeps coverage stable during the year ahead. A final useful check is to compare the plan against one normal month and one bad month. The normal month shows routine affordability. The bad month shows whether the deductible, network, and out-of-pocket maximum are tolerable when care becomes serious.